Imagine you have spent 40 years of your life building a fortress for your family. Every brick in that fortress represents a late night at work, a missed vacation, and a promise you made to yourself that you would never be a burden to your children. But today, in early 2026, I want you to look closely at the foundation of that fortress. You might notice that 70% of the weight of your entire life's work is resting on just 7 wooden beams. Those beams look strong right now, perhaps the strongest they have ever been. But if even 2 or 3 of those beams were to crack, the entire structure you have built could collapse in 18 months. I am talking about your retirement account and the extreme concentration we see in the markets today. Most people are sleepwalking into a financial disaster that they could easily avoid if they just understood the truth about how the system works. Before we dive deep into this blueprint for your future, please take a moment to like this video and subscribe to the channel. Your support helps us share these critical insights with more people who are searching for the truth in these uncertain times. Also, feel free to leave a comment below and let me know how you are feeling about your portfolio this year. Let us go back to a story from 1720, because history has a strange way of repeating itself when we least expect it. There was a man named John Law who convinced the French government to let him run their national bank. France was broke after too many wars, and they were desperate for a miracle. John Law offered them a solution by creating paper money backed by the future profits of land in Louisiana. Back then, everyone in Paris went crazy for shares in his Mississippi Company. People sold their jewelry, their family homes, and everything they owned just to get a piece of the action. The share price went from 500 livres to 18,000 livres in less than 2 years. But there was a dark secret that no one wanted to admit. The Louisiana Territory was mostly worthless swampland with no gold and no profitable trade. John Law was simply printing more paper money to pay off the earlier investors. When people finally started asking to trade their paper back for real gold, the system shattered. In less than 6 months, those millionaires on paper became bankrupt, and the French economy did not recover for decades. The reason I am telling you this in 2026 is that we are seeing the exact same pattern today, except this time it is not a swamp in Louisiana. It is 7 massive technology companies that now make up more than 30% of the entire Standard & Poor's 500 index. Think about that for a second. 7 companies out of 500 are holding up nearly a third of the weight of the entire American economy. Every financial advisor has told you to buy and hold index funds because they are supposed to be diversified. But if 7 companies represent 30% of your money, you are not diversified. You are concentrated. In the 1990s, the top 7 companies only made up about 15% of the index. We have doubled that concentration in 25 years. And the industry is acting like this is perfectly normal. The financial world loves to use the word passive, but there is nothing passive about letting your life savings be dictated by the whims of a few CEOs in Silicon Valley. You might think these companies are too big to fail because they are so profitable right now. But let me tell you about the Nifty 50 in the early 1970s. These were the 50 stocks that every institutional investor said you could buy and never sell. Companies like Polaroid, Xerox, Kodak, and Sears were the kings of the world. People said you did not even need to look at the price because growth was guaranteed forever. Institutional investors decided that valuations simply did not matter for these blue-chip giants. They poured money into these stocks, driving prices higher and higher, until the high prices themselves became the only evidence of quality. Then 1973 arrived with an oil crisis and skyrocketing inflation. Suddenly, those growth stocks were not growing anymore. The crash was devastating. Polaroid fell 91% from its peak. Avon fell 86%. Xerox fell 71%. These were not risky startups. They were the safest companies in America. If you bought those safe stocks at the peak in 1972, it took you a quarter of a century just to break even on your original investment. Imagine working your whole life and then waiting 25 years of your retirement just to get back to zero. The same thing happened with tech stocks in the late 90s, and housing in 2007. And now, here we are in 2026, and NVIDIA has crossed a $3 trillion valuation. Microsoft and Apple are not far behind. NVIDIA is a genuine technology leader, but its value has grown 10 times in less than 3 years. The revenue grew, but not 10 times. What grew was the multiple that investors were willing to pay because they were afraid of missing out on the artificial intelligence revolution. We have seen this movie before, and we know how it ends. Your index fund is now massively dependent on a handful of companies staying at these historic valuations forever. If these 7 stocks drop even 30%, your entire portfolio will suffer a major blow, even if the other 493 companies stay flat. All that really means is that the stocks that have already gone up the most get the biggest share of your new money. You are automatically buying more of what is expensive and less of what is cheap. It is the exact opposite of what every successful investor actually does. They are not concerned with your personal retirement timeline. They are concerned with their own scale. If you are within 10 years of needing your money for retirement, you cannot afford to play this game blindly. Losing 25% of your savings when you are 30 years old is a minor setback because you have many years of income ahead of you to recover. But losing 25% when you are 60 years old can be a permanent disaster for your lifestyle. I want you to take control of your exposure before the music stops playing and everyone else is left without a chair. Step 1 is to actually look at your top 10 holdings in your 401k or your brokerage account tonight. Most people have never actually opened the holdings list of their mutual funds. They just assume that an index fund equals safety. If your top 10 holdings make up more than 25% of your total account, you are in a concentrated bet, not a diversified investment. Step 2 is to consider an inverse concentration strategy to bring balance back to your life. You can look for equal weight index funds, where every company in the index gets exactly the same amount of your money, regardless of its size. This simple shift can drastically reduce your dependency on those top 7 tech companies. You can also look at international developed markets or small and mid-cap value stocks that have been left behind for the last decade. In 2026, these neglected sectors are trading at 15-year low valuations compared to the major tech stocks. Historically, small-cap value has outperformed large-cap growth over 20-year periods. And yet today, they are trading at massive discounts because everyone is chasing the same 7 names. I am not saying you should sell everything and move to cash, as that would be a different kind of risk. I am saying you should prune your garden before the storm arrives. If 30% of the market is in mega-cap tech, maybe 30% of your own portfolio should be in assets that do not move with the tech sector at all. Think about real estate investment trusts that own physical property, or commodities, or Treasury inflation-protected securities. These are assets that actually own something tangible. Let us look at the math of why this matters for your peace of mind and your emotional health. If you have $500,000 and 30% is in those 7 tech stocks, that is $150,000. If those stocks drop 50%, which happened during the dot-com crash and the financial crisis, you lose $75,000 instantly. The rest of your money might stay flat, but you are still down 15% overall just from 7 companies. But if you had moved half of that money into uncorrelated assets, your loss might only be $15,000 instead. That $60,000 difference is the price of your freedom and your ability to stay retired. Action step 3 is to set up valuation tripwires today. These are simple, automatic rules that remove your emotions from the decision-making process. In the heat of a market crash, your brain will tell you to panic and sell everything. In the heat of a bull market, your brain will tell you to buy even more because of greed. You need rules that force you to rebalance when things get crazy. For example, you could decide that if any single stock becomes more than 8% of your total account, you sell it back down to 8% and put that profit elsewhere. Or if the price-to-earnings ratio of the general market goes above 30, you move a portion of your money into safer bonds or short-term cash. You are not trying to time the market perfectly. You are simply practicing valuation discipline. This is what every successful endowment and sovereign wealth fund does to stay wealthy across generations. Step 4 is the one that will help you sleep the best at night, and that is building a solid income floor. The reason people panic at the bottom of a crash is because they need the money to pay their bills, and the market is the only source they have. If you have 12 months of expenses in a high-yield savings account, you have the luxury of time. During the crash of 2008, the people with cash were the ones who bought stocks at a 50% discount. The people without cash were the ones forced to sell their life's work at the bottom just to pay their mortgage or buy groceries. I also want you to get very honest about your actual time horizon this year. If a major crash happens 10 years from now, you will be in a much more vulnerable position than you are today. The sequence of your returns matters just as much as the average return over time. The financial industry has spent decades convincing you that investing is too complicated for you to understand. They use complex language and technical charts to make you feel like you need them. Just as John Law convinced France that paper money backed by nothing was the same as gold, they want you to believe that index concentration is the same as real diversification. It is not the same thing. Look at what the smartest endowments in the world are doing in 2026. The Yale Endowment, which is one of the best managed pools of money on earth, often has less than 10% of its total value in standard United States stocks. They focus on private equity, real assets, and foreign markets that do not move in lockstep with the Silicon Valley giants. You can avoid anything that is sold to you as a guaranteed return or a safe-as-the-market product. If it sounds too good to be true, it almost certainly is a scheme designed to separate you from your money. Also, avoid the temptation to do nothing just because the process feels overwhelming today. It is not a neutral position. Treat your portfolio like a garden, not a single plant. You must rotate your crops and prepare for the changing seasons of the global economy. In 2026, we no longer have the tailwinds of 0% interest rates and expanding valuations that we saw for the last decade. We are in a new era that requires you to be engaged, disciplined, and proactive. When the next crash comes, you need to know that you did everything in your power to prepare. If you prepared, you will not feel like a victim when the headlines turn red. Instead, you will feel like a leader who has protected his family and his future. Imagine it is late 2027, and a global geopolitical crisis has caused tech stocks to drop 40% in a few months. Your neighbor, who did nothing, is now terrified and has to delay his retirement by another 5 or even 10 years. He sells his stocks at the bottom because he cannot take the pain of watching his balance drop every day. But you, because you rebalanced today, only saw a minor dip in your total portfolio value. You have your cash buffer, you have your income floor, and you might even have enough extra cash to buy more shares while they are at bargain prices. That is the difference between building wealth that lasts and being wrecked by a system that does not care about you. Wealth is not built by hitting home runs or guessing the next big thing. It is built by not striking out and staying in the game for the long term. If you can avoid the catastrophic losses, the math of compounding will do the heavy lifting for you. Take some time tonight to check your actual exposure and fix any risks you find in your accounts. Build that cash buffer and set up your own rules for rebalancing your assets. I believe in your ability to manage your future and protect the legacy you have worked so hard to build over the last 40 years. Before you go, please make sure to like this video and subscribe to the channel if you found this information valuable. We are dedicated to helping you navigate these complex markets with clarity, honesty, and confidence. Leave a comment below and tell me one thing you are going to change about your portfolio after watching this. I read every single comment, and I truly appreciate your engagement and your feedback. Thank you for spending this valuable time with me today. Remember that your peace of mind is the greatest investment you will ever make in your life. Stay safe, stay disciplined, and I will see you in the next video.